Hello, everybody. Luke Gromen, FFTT. Hope you had a great weekend, great week off while we were off, or at least were able to enjoy the summer. Beautiful summer in the Midwest last week. So, back in the saddle. Excited to be here. With that, we're going to jump right into some of the questions. The first question is from NP. Could you please expand on the tweet below? I found it intriguing. It was something I replied to my friend Michael Cow, and I said, if the yen dollar versus the 10-year treasury yield correlation holds as it should, it will make this a recession like none we've ever lived through. And what I mean by that specifically is the weaker the yen gets, the higher 10-year treasury yields have been. It's been a very tight correlation for much of this year with that. And so, like I said, there's been this tight correlation between the yen dollar versus 10-year treasury yield. The lower the yen goes, the higher the 10-year treasury yield goes. A couple different factors to that. First off, Japan owns about $1.4 trillion, give or take, in treasuries. They've got another $1.4 trillion or more in US dollar assets. They will sell dollars. They will sell treasuries. They will sell stocks. They will sell US assets to raise dollars to defend the yen. First off, so yen gets too weak. First thing you sell are treasuries to raise dollars to then sell dollars by yen. Okay, so that's number one. So again, the weaker the yen gets, the more likely Japan will be to sell dollar assets to raise dollars to sell dollars to buy yen. And as the U.S. sells, or as Japan sells those treasuries, all else equal, that's upward pressure on treasury yields. Okay, so that's the first. Secondly, the weaker the yen goes, the higher energy costs go in dollars, right? Energy is still mostly priced in dollars. As energy gets higher for Japan, as the yen gets weaker, Japan goes from a current account surplus to a current account deficit, twin deficits, not just fiscal deficit, which they've had for a while, but their trade deficit because their energy costs go up. That's already begun happening earlier this year. That means the yen gets weaker as they have this twin deficit problem for the first time really in a long time. That means they have to sell more treasuries and dollar assets to raise dollars. Same problem. Treasury yields up, all else equal, and U.S. assets down broadly. Then there's another element that I think is less well understood by a lot of market participants, which is that dollar FX hedging costs for Japan rise as dollar rises, all else equal. And I'm not going to go down the rabbit hole of why that is, just it is. So the higher the dollar goes against the yen, the higher the hedging costs for both the BOJ, but more importantly, the Japanese pension and insurance industry to hedge their dollar bond exposure. That means the higher the dollar goes, the more negative the FX hedged treasury yield is for Japanese investors. It's already very negative on an FX hedge basis. So basically, if you are a FX hedged, and most of them do FX hedge, they're earning negative yield after hedging for FX because the dollar's too strong. And so they either sell dollar bonds or they don't renew their dollar bonds, or they buy JGBs instead of treasuries. Again, it increases marginal treasury supplies. All else equal, supply up against constant demand equals price down, yield up. And that leaves more treasuries for everyone else to buy. Who else is going to buy them? Well, the EU's having some energy problems, as you're probably aware. They're probably not buyers of treasuries. They're probably sellers. The Chinese, probably sellers. Russians, we know they've already sold. And so you can see there's just this dynamic, multiple-pronged of more treasury supply effectively. Then when we say, okay, the Fed's going to do QT, more treasury supply. Then we do, etc. All of this happening as the U.S. is increasingly apparently heading into a recession alongside Europe and pretty much the rest of the world. So this dynamic of yields up in a recession is something that happens in very, very frequently in emerging markets with balance of payments problems. It is not something we have seen in our lifetimes in the treasury market, but we've already begun seeing signs of it. It's something we've said a lot about. The bottom line is if the yen keeps weakening, you're likely going to see Treasury yields rise. If you have a recession, you're likely going to see, after a brief period of yields down, which I think might be ending as we speak, Treasury yields rise. And so let's watch that going forward. From Bill, if the U.S. government enacts some version of Operation Twist, does it change your outlook on when the Fed pivots? I think a version of QE Twist is the Fed pivot, a version of the Fed pivot. There's a number of different ways they can do it, but I think they will likely try to convince us all that it's not a pivot, that it's not an increase of liquidity, that they're not doing it because there is a financing problem for U.S. government deficits, given everything else that's going on in the world, part of which I just described. I think they'll try to sell that it's not a pivot in the same way they tried to sell us all in the fourth quarter of 2019, that in response to the repo rate spike, that was not QE. Remember, Powell said it's not QE. End of the day, stock market didn't care. Stock market ripped in the fourth quarter of 19, and I think if we get Operation Twist, the stock market will rip again, as will commodities, gold, Bitcoin, etc. From OK, how ugly do you think oil could get in terms of price? Do we have a shot at reasonable prices this decade? I'm assuming you mean ugly on the upside, just given by what you said by reasonable. In my opinion, peak cheap energy that we are seeing, for example, the four biggest shale basins in the U.S., they are declining at a 5.8% rate on a monthly basis on an installed base of 8.4 million barrels a day. So basically, for round numbers, you need to grow production in U.S. shale basins by 500,000 barrels a day just to stay even. Peak cheap energy. You can find it. It's going to be more expensive. It's an oversimplification, but it's not a gross oversimplification. And so the punchline there is there's one of two ways to get significantly lower energy prices, and in particular fossil fuel, oil, gas prices in the next, call it 2 to 3 years. Number one, you develop and commercialize very rapidly a major productivity enhancing technology, some sort of portable nuclear fission or fusion environment, or energy efficiency technology, something like that. It's a stretch on a 2 to 3 year time horizon. The alternative is you assume some truly horrific economic and humanitarian outcomes. I'm not going to develop further. The bottom line is I think it's very supportive for energy, fossil fuels, and gas over the next couple years. I think is pretty safe to say, without a major productivity enhancement or some truly horrific economic and humanitarian outlooks. From Alex, how do you try to poke holes at your own thesis to ensure you are not believing what you want to believe? Do you engage paid resources, outside paid resources, or outside resources? Note, not having FFTT this week was hard. Well, thank you for that kind compliment. The way I make sure I don't have a confirmation bias is really two things. Number one, I make sure I can argue the opposite side of my case better than the people making the opposite side of my case. And anytime that they have a better argument on some, whether it's short-term or long-term time frame, if they have a better argument, I switch. It's that simple. Whether that's tactically or whether that's strategically, in terms of whatever particular view I'm making. The other thing I look for is on the people on the other side of the argument, I look for something that I know that they don't, something they're not talking about, something they're not aware of. And when I see those things, and those things are very big blind spots for them, that increases my conviction. And quite frankly, I see a number of those at the moment. So let's watch from there. From Winston, you have touched on this a while back regarding China's water issues, which are now starting to become more acute. Do you have updates and or comments on the situation, especially as how it might affect the global economy? This is a biggie worth watching. It's something we talked about last fall. We've talked a little bit about it again earlier this year. I find it fascinating. It's one of these things, like I just said, I look for what people are arguing the other side. You're seeing people on FinTwit talk about Chinese demographics in 10 years, 20 years. They're screwed. The water issue threatens to be an issue in 10 to 20 months. They were looking at the wrong thing. Look, if China's water issues, they have a very long history as a culture of managing this. It's not a surprise to them that they have water issues. It's been a long-standing issue. They've been knowing for over a decade these issues are going to get acute. With that said, it's still getting acute, and it's getting acute, it seems, at least tactically intermediate term as well as intermediate term at an accelerating pace. If China has a production problem, where you're starting to see a little bit already in some niche areas, if they have a production problem due to water issues, you're looking at the entire financial system going. It would likely be very inflationary. I mean, you're basically looking at a version of COVID shutdowns, supply chain problems. My guess is it's probably positive for the dollar against other fiat currencies, and probably really negative for the dollar and every other fiat currency against energy, goods, and gold. That basically you'd rather have stuff than fiat currencies, because supply chains will be structurally impaired much in a similar but longer way potentially than we saw during COVID. From Mike. Luke, how are you thinking about a Fed pivot just by some time? Are you thinking the U.S. can walk the line, inflating our way to 70% debt to GDP over 5 to 10 years without a quote-unquote depression? Over the past 120 years, per Reinhardt and Rogoff, two of the foremost experts on sovereign debt, 98% of countries that were in the U.S. debt to GDP and deficit position that we saw in 2020 and 2021 defaulted on their debt, either via a restructuring of the sovereign debt, or much more often, in significant inflation. If the U.S. wanted to restructure its debt without a quote-unquote depression, it needed to do so probably 20 to 25 years ago. When we had a peace dividend, a unilateral moment, that's when you needed to restructure these entitlements, etc. We missed the window. That's not going to happen, in my view. So now, if you want to do this without a quote-unquote depression, you need one of two things. You need a massive productivity-enhancing technology, portable fission, fusion, developed, commercialized, rolled out over the next year, 2 years. Probably unlikely. Another possible way out is that a quorum of boomers pass on in a compressed time frame, reducing U.S. government entitlement obligations, the off-balance sheet stuff, while simultaneously leading to a increase the wealth, a big chunk of wealth of the boomers passing to their kids, who can then pay off their debt and invest that money. That would be pretty inflationary. That would get the U.S. sovereign problem without a quote-unquote depression on either a nominal or real basis. If neither of those things happen, and to be clear, I am not rooting for the latter of those two things, I'm just simply making a mathematical observation, then I think the choice is quote-unquote depression on either a real or nominal basis. Nominal, like I said, I don't think you're going to do a restructuring. It's just not in the cards. And so you're likely to get most likely a quote-unquote depression on a real basis, which is sustained period of high rates of inflation and significantly negative real rates for several years, 10, 20% CPI inflation for several years, and then you normalize policy by raising rates after debt to GDP is low enough over the backs of basically significantly repressing and devaluing bondholders. That's really, barring those other two solutions, the most likely scenario. Two more, and then we're done for today. From SE, the consensus seems to be that Democrats will lose control of both chambers after the election. How would the markets react if they keep a majority in both chambers after the election? You know, it's a really interesting thought exercise. It's something I've just sort of touched on in my own brain a little bit. I've not written it anywhere. I'm not a big political strategist, so I don't try to focus on who's going to win, because I just don't know. However, if you did see the Democrats keep both sides of the House, my opinion from a financial side is that it would probably be good for the markets, particularly given this recent shift by the Biden administration towards industrial policy that I think is long overdue, starting with semiconductors. So I think you would probably start to see that as being, I think the markets would see that as positive. I also think it'd probably be very good for energy, because I think you'd probably see continued restrictive policies in terms of drilling and production, in which case the oil price and gas price would likely continue to elevate in the U.S., and that'd probably be good for energy and other commodities. And then finally, given the main touch points of your macro thesis, if you could pick any country to live in for the next 20 years, where would it be? It would be in the upper Midwestern United States of America. Look, there's a very few parts of the world that have wide borders in terms of wide moats of the two oceans on either side, and even fewer parts of the world that have a self-sufficiency in fresh water, energy locally, and food locally. Upper Midwest again. And incredibly, the American public is leaving this area on net, and have been for years, and moving to areas that are non-self-sufficient deserts with non-self-sufficient public transport and or swamps. So to me, I think the upper Midwestern United States is arguably the best positioned place to be in the entire world. It is my favorite emerging market to invest in the world, having been hollowed out for the last 30, 40 years by U.S. financialization and economic policy. So with that, thank you to everybody for joining me. As always, if you're interested in learning more about what we're up to, check us out at FFTT-LLC.com. It gives you a little bit more information about what we're up to. You can also look at our Tree Rings product, which is 10 Most Interesting Things. And basically brief synopses of each of those points and how they either support or refute the way we were thinking about the world when we saw those 10 most interesting things that week. So, as always, thank you for joining me. I look forward to catching up with you soon. Everybody have a great week. Take care.